Hey everyone, it is Evan here from the Trade Risk on Friday, July 12th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So it feels good to be back. I've been on vacation the past couple of weeks, so this is the first video that we're getting back into the rhythm, and I know I'm rusty because I just did a 20-minute recording and finished up everything and realized I did not hit the record button, so I just talked to myself. I did this whole video for 20 minutes to myself. So this is part two. This is the rust. This is why we can't go on vacation, because we forget the operating procedures here. So let's get into it. Round two, market technicals dashboard. This is where we like to start our videos. You can take a look here at the major markets over the past week or so. It's been a strong push to the upside. All of the major indices finishing here on Friday in green territory. The past 5 days, only the Russell 2000's in the red. Everything else is green. And all of our key simple moving averages, we are above all of them in the major indices. If we scroll down a bit further, we take a look at sectors here. We got semiconductors, energy, and discretionary leading the charge to the upside. On the downside, it's healthcare, it's biotech, healthcare, and material stocks all in the red. When we look at major markets, we have energy, oil, natural gas, silver all to the upside here. And on the downside, we have volatility, we have TLT, which is long bonds, and China. Let's jump into the charts now, take a look at what's going on here in terms of levels. This is the S&P 500. We'll switch over to a slightly less busy view of it. This is the cash market, and this is a weekly time frame. So each bar represents 1 week worth of trading. And what we can see this week is that we closed right at the top end of this week's range at all-time highs, clear skies above us. There's no overhead resistance, and the bulls are pretty much firmly in control here for the S&P 500 for the second week in a row, closing at new all-time highs. So the way I'm looking at this is this 29.55 area. This is where we failed. These were the prior all-time highs at the end of April. That's where we just broke out of over the past 2 weeks or so. That is the line in the sand now. As long as we are holding above 29.55 as a trader anyway, I certainly want to be long this market and look for continued upside. If we start to lose 29.55, that would get me, that would put me on at least pause for the short term. That's the sort of the line in the sand that we get to look at going forward here. But other than that, it is clear sailing above. There is no overhead resistance. S&P 500 is breaking out here, and especially when we look at something like the VIX, which if we pull up that chart here, this is the volatility index. You can see this is back trading at around a 12 handle here, so very kind of subdued for recent levels that we've seen. But this 12 area for the VIX, that tends to be where, you know, the market can enter that kind of sweet trending spot, which we really haven't seen for a number of years. We have to go back to 2017 since we've seen a market that has just kind of gracefully been just grinding higher to the upside, very subdued volatility, and just kind of, small intraday ranges, small overnight gaps to the upside. That tends to be what you see in that type of environment. That's what we could be entering here now. Again, it's not a prediction, just looking at what we have currently in front of us as facts. But if we start to continue to see this market grind here at new highs and hold new highs, and we see a low VIX, we could be entering that sort of sweet spot where we just kind of get that low intraday ranges, low volatility, grind higher, and we'll see if we can get that. It's unusual, summertime usually brings some volatility, so let's not get too ahead of ourselves. Let's still be mindful of outstanding risk. And again, that's why I say if we start losing 29.55, if we see some abrupt failure up here, high volume reversal, that is always something that should get us at least paying attention, potentially defensive if your strategy and time frame warrant it. But until and if that happens, I'm going to go with the trend to the upside here, and I want to be long this market as it continues to break out. Now, daily chart. of the S&P 500, not too much else to add to it. We could refine the 20, we were using 29.55 as our line in the sand. You could get a little bit closer and say Tuesday's lows of this week, which was around 29.63. That's where the market kind of reversed and then kind of started to push higher and break out earlier this week. So 29.63, you could refine that level there. And if we start to lose that, then again, the active shorter term traders could start to take note. If we go to the Russell 2000, before I left on vacation, this was the market that had been underperforming, the index that had been underperforming. And as I returned here, it is still the area of the market that is underperforming. It is moving sideways here. And really, it's not doing a whole lot wrong. It's not breaking down. It's not breaking through support. It's merely just going sideways here. And, when we have these long bull markets, or when we have markets that are in these uptrends, they tend to go through periods of rotation. We have different sectors of the market lead at different times, and the Russell 2000 could be doing exactly that. It could be fueling up here for a move, and especially with how tight this has gotten over the past week and a half of trading around this 155 area, this could move pretty quickly here if we get some volatility expansion, again, over, I'd say about 157 or so, then this could really start to ignite here. 160 is the big kind of multi-month, frankly, almost multi-year at this point, resistance that the Russell has been underneath. So that's the big level to pay attention to, especially on like that weekly closing basis. But if we can start to rally above 157, then it can very quickly make a run for 160, and we could be breaking out in no time. So let's not sleep on it. It has been underperforming, it has been lagging, but it is holding up here and really kind of just fueling up for some type of big volatility event. So we'll see if that can happen to the upside. We'll see how this range resolves next week. It's something I'd be paying attention to over the coming days and weeks. Last but not least is Nasdaq. Nasdaq looking strong here, also breaking out to new all-time highs, just like the S&P 500. 191, that is the highs that we made in April for the Nasdaq 100. So long as we are closing above there, I think that's a positive, constructive sign for the market. You can see the MACD here leading to new highs as price makes new highs. That all kind of checks the box for some good bullish behavior. So as long as we're holding above 191 or so, I think you got to be constructive here. Some type of sharp reversal lower, high volume reversal lower, that would get me concerned. That would get me at least short-term concerned, or give me pause. So we'll see, if until and if that happens, I think you got to respect the trend here to the upside across all of the major U.S. markets. So that is it. That is what I got here for the major markets. Last but not least, actually, is just earnings season. It's coming. It's kicking off in the next couple of weeks. Really, I don't know if it's next week or, it might be late next week. I got to check the calendar again. But earnings season is coming. So again, as we start to break out here at new highs, let's keep that in mind. Let's not fall asleep. We are constructive, or at least certainly the charts here are telling us to be constructive and have that long bias right now. But if we do get some catalyst that changes things up, stirs things up, causes the market to go off tracks and start to reverse and retrace from these all-time highs, earnings season could be that catalyst. So we'll have to see, but just pay attention, check those individual holdings if you do have individual stocks into the next couple of weeks. Now let's get into some other major markets. TLT here did have a meaningful week. You can see it was down 1.67%. It took out the prior 5-week lows. Again, when I look at this chart just from a longer, bigger picture perspective here on this weekly basis, you can see the MACD momentum has still been rising here. It's just coming off of its all-time high levels. It's had a strong, really 2019, a strong recent multi-months in particular though, and we haven't seen a pullback here in many weeks now. So I think this type of move, just lower, pushing lower here, retracing, is well warranted. I still wouldn't count it out. Again, I still like the overall positioning here for TLT longer term. I think if we can find some higher lows, in the mid 120s, even pulling back to 125, 126 area, it seems perfectly reasonable to me. But if we, can stabilize there and then start to retrace again, then that could set us up for a trade maybe into, end of the summer or something around that time frame. But for now, it looks like it needs to cool off a little bit. We've had some negative divergence up here in terms of momentum. So again, a pullback here, reset, if you will, for TLT seems fairly, par for the course given the recent action. If we go to metals next, you can see GLD looking real strong here again. This has continued to act well. This had this big breakout in the end of May. Just take a look at all of the volume that poured in here on this breakout to the upside, multi-year resistance it was breaking out from. And over the past week or two, it's really consolidated mostly through time. There hasn't been a big steep pullback in price. It's really been kind of just holding up, acting well, and holding above that 130 area, and just really been digesting pretty orderly fashion here. So I'd say if we can start to get closes above 134, this could be a quick continuation pattern that starts a second leg higher to the upside, so keep an eye on it for GLD. Now, silver here, we're still looking at this to play some catch up. We had a position in silver. In fact, we got stopped out of this at break even. I think it was this day here on Friday. We got stopped out. I think we originally got involved here. Our stop got just tight enough, trailing it up, that we got exited at break even. But it did manage to hold on here. It is starting to act a bit better here, holding above $14, looking like this could be some type of higher low as well. Still, ideally, would like to see silver start to outperform and outpace gold. It hasn't quite happened just yet. Maybe this is the start of it. Maybe if it can start to close above 1435 or so, then it can be off to the races again. I still like the overall positioning here in silver. Going to look for a re-entry potentially in the coming weeks here if it sets back up. But silver holding above $14, that's the key area, and we'll see if it can start to outperform. Last but not least, if we go to energy, we got oil here, which is acting well again. Strong move to the upside, trying to take out last week's highs, back above 1240. Remember, this is, this broke down pretty violently at the end of May, or mid-April, end of May. And it is recovering about 60 or 65% of that move so far back to the upside. There's lots of overhead supply coming in around that $13 area. So for me, short-term trends do remain higher here, but just kind of too much of crossroads. Not really interested in this one way or the other, at least for my time frame for USO. Short-term momentum and trend is still to the upside, so you can play with that. MACD trying to lead here as well. So right now favoring the bulls in the short term. Natural gas, I do think, is actually more interesting here. We've been really hating on natural gas for the past many weeks now, many months, as basically all time frames has just been pointing drastically lower here for natural gas trends and momentum to the downside. But take a look at just even this average 20-day volume here at the bottom end of my chart. You can see just the steady, gradual increase in the average traded volume here, which says that there's interest down here. There's enough transaction going on here. There's enough shares moving hands, and this is starting to pick up some interest below that $20 area. And given the fact that the MACD had been kind of having some positive divergence there, volumes picking up, we were extremely oversold on all metrics. It does seem like natural gas has found some type of short-term bottom. It's certainly already up 13-15%, but it could even be more than just a short-term bottom. To me, I think natural gas looks actually interesting for a tactical long trade here on dips, back into the $20 area. If we start coming back down to these lows, I'll be looking at that as possible, a trading opportunity, not looking to hold it for long term, but just looking to be active on it. I think tides have turned here just a little bit now for natural gas. Easily could eat the words on this as if this just totally rolls over. It is kind of a higher risk trade. It's certainly the one of the more beaten up plays. There are easier plays out there, but I do think it's something to pay attention to there if you're short term and active, especially with this pickup here in volume. So that's it. That is what I have for the major markets. Let's jump into sector analysis now and take a look at what performed best, what performed worse. On the upside is semiconductors. This really took the elevator down and then the elevator right back up over the course of mid-April. This pullback here was about 20%, almost 20% from high to a low here in about 2 months time, month and a half time. And you can see as quick as we sold off, we're actually getting back up here almost just as quick. We've only retraced we've retraced about 70% of the move to the downside already. And it's looking like we want to continue to march higher here back up to these prior highs. So it does look like semi's kind of, looking for a retest, if you will, of these prior all-time highs around 120 or so. Short-term trend is higher. I mean, volume has dried up. That is, notable on this move higher, but it doesn't mean we can't continue higher for semis. So no real core, clean trade setup I'm seeing there, at least for my style. But it does look like trend and momentum is all back to the upside there. XLE number 2, second best performing this week. This makes sense. Oil has been back on the rise here, maybe a little bit of inverted head and shoulders bottom over the past 2 months of trading. If this can start to rally and continue to rally above $65, then that looks pretty good for higher prices as well. XLY is really one that's just really running away here to the upside. It broke out last week above $120 and it's continuing to march higher up here, really kind of defying gravity and just running up. It's made 12 consecutive up days in a row. So discretionary here, it's a real tough chase, but certainly is off to the races and moving to those all-time highs. If we go to the downside here, it's biotech, and biotech just it's had a few different attempts in here to rally and to start to participate in this market, but every time it starts to rally, it really just gets hit back on the head and it just moves back to the downside here. And really, if we just zoom out, it's been moving sideways here for a long time, really all the way back to 2017. In fact, between $100 and $115, $120. It's just been really messy moving sideways here, and it's in the middle of that range right now. So I don't see any near-term resolution of that. There's certainly short-term opportunities here, but it's got to collect itself. It's got to hold above $100. Right now, it's kind of in no man's land, so I'm going to give it the time it needs. XBI, to me, is set up a little bit better. It has got, more of an attempted sort of structure and sort of an uptrend from the beginning of the year that it's trying to hold on to. It's still pretty messy, though. It's still kind of indecisive here in the short term, so, individual stocks are set up better than those ETFs outright, so I'd pay attention to that if you do want that biotech exposure. XLV, which is healthcare, a little more broad, is third worst performing this week. It was down on the week, but this certainly has, a better character to it than biotech outright. This $95 area, this has basically been the top end of the range for the past couple of years, and it's still, taking its time as it works itself back up to those prior highs. It's holding up above $91, $92. I'd say it's ideal for the bulls to hold this area around $91.50 or so, and if it can do that, then, maybe in another couple of weeks or so, it could make another attempt at this $94, $95 area, and if it can start to break out, then things would start to shape up there for XLV, but certainly needs more time, at least in the short term. Last but not least is XLB. This was also negative on the week, but again, I would not want to count this one out as well. I do like the heavy volume that came in at the end of June here, and is still, to me, suggests that we saw some strong rotation there, that it's not going to easily give that back up. There's a lot of sideways supply in here around $59, $60. I think that's what we're dealing with right now. That's why you're seeing some chop. But for me, I still like XLP overall, especially if we can hold above $57. I think it's an interesting area of the market that could see further rotation. So that is it. That is what I have. Thanks so much, as always, for tuning in and watching. It feels good to be back. I'm hoping that I hit the record button this time around and that all of this is saved so I can get it uploaded after a 2-week hiatus. Again, thanks so much for tuning in. As always, have a great weekend, and I will see you next week.